Hey, what's up guys? John here. We're going to be stepping into most likely a huge sell-off in the stock market. We might see a lot of businesses trade hands. We're going to see a lot of activity because here's what's happening. Capital gains, tax hike, and more may come just days after Labor Day. So they need to raise taxes essentially across the board to fund this $3.5 trillion infrastructure bill. And how are they going to do that? It's likely going to be by coming down hard on people that have something to come down hard on. The House Ways and Means Committee may release a draft of the $3.5 trillion social policy bill as early as next week, including the tax hikes needed to pay for it. That's left wealthy taxpayers scrambling to do proactive planning, especially to avoid the possible doubling of the capital gains tax rate to roughly 40% from 20%, which could retroactive to the date legislation is introduced. For folks who need to raise cash or reposition assets, it may be prudent to sell those assets the next couple days, warned CPA Bob Keebler of Green Bay, Wisconsin, in an alert to tax and financial professionals on Lindbergh Services. So we're going to likely see a lot of people start selling off. The stock market's very high. A lot of people made a lot of money across the board. So I believe we will see this. But here's what's happening. It's not just capital gains tax hikes that's at stake. There's a lot more than half a dozen tax hikes that could be used as revenue raisers in the bill. The Democrats' social policy goals are ambitious: paid family and medical leave, expanding Medicare, and to include dental, vision, hearing benefits, extending the enhanced child tax credit, as well as provisions to address climate change. So it's going to be a massive really undertaking. It's going to be huge. Who would pay for this? The Democrats' budget blueprint promises no new taxes on families making less than $400,000 per year, small business and family farms. It calls for tax fairness with high-income individuals. What people don't realize, I think, is that they don't understand that people making over $400,000, generally probably a small business owner, medium-sized business owner. And when he gets taxed or she gets taxed at that level, what happens? They're going to likely cut back on staff, on jobs. They're going to restructure their business. They're going to likely push on the cost to the consumer. They're going to do everything that they can do to remain profitable. So $400,000 is not that much money anymore. And we're going to likely see that hit the middle class much harder because the wealthy, they have really good tax planning. They have a whole team generally that's going to oversee how they are going to shield themselves from these taxes. Meanwhile, the middle class, they don't have that type of infrastructure. So I believe that the wealthy will be they'll be well positioned to take advantage of the distress in the market, and this is likely going to be a great impact to the middle class. Who would pay for this? So you're going to hear tax increases, no doubt, says Pamela Lucia, head of the trust and advisory practice of Northern Trust. Everything is sort of fair game. In Northern Trust white paper, navigating possible tax policy changes hedges the likelihood of various tax hikes in play. It puts the increase in the top individual income tax rate and a small increase in the capital gains to 25 or 30% in the most likely category. We're acting as if all of these could be part of the final law as they negotiate and search for revenue, she says. So the thinking is that tax hikes are going to happen. It's just a matter of which ones and when. It's like picking the NCAA bracket, says Keebler. You don't know what the final deal is going to look like when it's carved at 3 in the morning. Here's a laundry list of what is potentially coming. So you have the individual tax hike. The top individual income tax hike could be from 37 to 39% for those making more than $400,000 a year. Planning tips: accelerate income, consider Roth IRA conversions. You have higher capital gains tax, and administration proposed would double capital gains from 20 to 39.6%. So you take these risks in the market, betting on a stock, betting on a crypto. If your capital gains, you're paying double the tax and you're taking the same amount of risk, what's going to likely happen is it's going to take away a lot of the desirability to place that initial bet. So I believe that people may start taking money off the table very, very soon. And qualified dividends. Lucina says the Northern Trust predicts that smaller increase with a new top rate of 25 to 30%, more likely. She's already been working through the calculus with clients to figure out whether they should or shouldn't sell assets. Taxes are a factor, but not the only factor, she said. One client's selling a food distribution business, and rather than selling outright, he's selling it on an installment basis, which allows him to defer the capital gains. If the tax hike passes and is not retroactive, he can opt out of the installment sale and take the gains all in 2021 under the lower rate. Planning tip, if you don't need the money to fund short-term goals 1 to 10 years, perhaps you're better off holding and not selling the assets. 1 to 10 years, that is a very long time in this world. You look at how fast things have changed just over the last 2 years, people thinking 10 years out, that's a lifetime. So I think that we're going to start to see a lot of fear step into this market. Deduction caps. Taxpayers could face a new cap on deductions, including charitable contributions as well as Roth IRAs, 401ks. Contribution Keebler has this one on the short list of most likely tax increases. Instead of getting the deductions of, say, 37% of income, a cap of 28 or 26% will be imposed. So another planning tip from them is consider maximizing your retirement plan. Again, like a retirement plan, with the way that things are going, I wouldn't be thinking 40 years out in a retirement plan. I wouldn't be. I'd be thinking of the short term, what can I do right now that's going to create massive value to accumulate great wealth. The more wealth you have, the more success you have, the more ability you have to pivot in this, this world that we live in. The longer out you're thinking, 20, 30, 40 years, who knows what's going to happen there. Tax carried interest and ordinary income. Imagine an accountant, lawyer, and an investment manager all working on the same deal for 6 months, pushing paper. At the end, the banker pays half of the tax that the others pay. A proposed tax law change has bipartisan support, would level the playing field by taxing carried interest as ordinary income instead of capital gains. Huge. Capital gains taxation at death or gift. Under the current law, when you die, your assets get stepped up in their value to their value at the date of your death. That means you and your heirs avoid paying capital gains tax. The administration has proposed making such capital gains taxable at death without, or when transferring gifting. That would be a $1 million exemption, $2 million for married couples, plus $500,000 capital gains exemption for primary residence. Return of the gift and estate tax. The Trump tax cut of 2017 temporarily doubled the estate tax exemption through 2025, leaving fewer than 2,000 estates a year that face federal estate taxes. The exemption level is now $11.7 million per individual, set to revert to $5 million. So you're going to cut that in half, more than half, for inflation. What's possible? A return of the base level exemption to $5 million, meaning a return of gift and estate taxes for many more families, less likely a return to $3.5 million, the 2009 level, and restricting grats and valuation discounts. There are many other estate planning techniques that the rich use to avoid taxes. Some of these could be at play. Grat, a valuation discount, lets wealthy families transfer assets to their heirs virtually tax-free. Proposals under consideration include a 10-year minimum annuity term for grats with a minimum gift amount to be contributed. Valuation discounts used to pass down family businesses could be curtailed, but this would get more pushback. Another planning tip, and the SALT cap deduction, which is huge. Finally, there's one potential tax break for the rich in the mix. The budget blueprint calls for revamping the SALT deduction relief from the current $10,000 cap on state and local tax deductions. This could mean big savings on federal taxes, especially for folks in higher tax states. To me, it's not a matter of if, it's a matter of when and which taxes that they choose to increase. I believe the economy is standing at the edge of a cliff, and it all depends on how they approach the next couple actions that will determine the fate of hundreds of millions of Americans. I believe now is the moment to be very cautious and shield yourself from any unnecessary risk. Always measure the downside and make sure you have plenty of capital, because in a market of distress, it's always great to have too much cash than not enough cash. That's when the great opportunities become available, and that life-changing investment can be right around the corner. Please smash that like button. Consider subscribing on this channel and my personal channel. I'll leave links pinned down below in the top comment, and I'll see you guys in the next video. YouTube Success Blueprint. To learn more about growing your YouTube channel and creating passive income as a YouTuber, register for my YouTube Success Blueprint by clicking the link in the description below this video.